Hey, what's up, guys? It's your boy 4K Bargain. So if you have watched my previous videos, you heard me say that I started to make I am 80% profitable. If that makes sense to you, and if that's something that resonates with you, and you want to achieve that, I'm willing to share a free strategy. No, it is not a strategy. Actually, it is not a strategy, because these gurus who are online, they tend to take advantage of people who don't know about trading. But if you remember, trading is not something new. And most people have heard about trading recently in their lives, or even if they had it a long time ago, they started doing their research recently. But if you know about me, you know that I already talked about this. We already learned Forex trading from primary school, and it is something which is real. And most people are so in denial of this, and I guess they need to be. Let them be. Let everyone be. Let everyone adopt the desires they want, the behaviors and their lives they want. So basically today I'm going to give you a framework on how to analyze the market. It is not a strategy, and the most YouTube gurus, they call it a strategy. The reason why I hate teaching on YouTube and teaching people on how to trade, it is because I will be one of these gurus. I'll be taken as one of these gurus, and I don't want my reputation to go that way. So I prefer to keep it to myself and use it. But if you found this video, know that this is not a strategy. Let me explain something, and I will show you where the strategy fits in. Yeah, there's a strategy, but first of all, that strategy alone is not going to give you money. It is not going to position you somewhere where the money is going to flow. First of all, you have to understand a lot of things. And I'm not going to teach you about any strategy today, but I'm going to give you the structure that I follow and until I became 80% profitable. This is not taught anywhere. I don't think you're going to find this on YouTube. I want you to go through the YouTube videos, or maybe you're watching this video for the first time. I want you to tell me on the comment section that if you have ever you have ever heard about these terms, but did people really structure them the way that I've structured it? The way that I've made a framework that you can follow, even if you are a beginner, you are going to see the market as a person who has been trading for 20 plus years. You are going to see the market psychology and understand it deeply. This is a new thing in the market. No one is going to tell you this, and most people are not going to find this video. But I'm telling you, 5 to 10 years from today, people are going to look back at this video, get profitable from it. And remember, this is not a strategy. And once a strategy has been shared online and a lot of people are using that strategy, the strategy changes, because the market is reacting in real time. The market is reacting to how people, those are not candles. Candles are not behaving. No, they are price movements. So the stop loss that you are going to put, that is the new order. That is the new market order. So remember that if everyone uses that strategy, then that strategy is not going to work, because it is going to move to another value. The price is going to move to another value, because that now you have created this stop this market order here. It has to be filled. And price the candles you see, the price moves not just to impress you or to follow some I don't know, some dogmatic, I don't know, some things you do, or maybe some lines. No, it doesn't do that. The market moves in order to fill some people. It moves in order to fill some people, either buyers or sellers. I'm going to explain that in depth. If you are interested, comment down below. This thing is very wide and we can talk about it all day. But first of all, you have to understand the framework before start doing anything. Before you start trading, before you open a trading account, don't open a trading account until you have finished almost 2 years in the market without trading. Just looking at the charts and fantasizing over them and masturbating over them. That is the only way you are going to understand the market. I'm telling you, it is not that simple. These people are gambling, and most of them, they are IB broker educators. They are being paid to teach you. They are being paid to introduce you into the brokers so that your money can be taken away as liquidity for the big market makers. If you are understanding today, so basically let's head straight into the framework. What do I call it? I call it my blueprint. Let me say. Let me get the phone out. So I'm hoping that you are going to see the board. Let me get the phone out so that I'm able to teach you, so that you are going to understand. So the first thing, it is called Evans Ongwae trading blueprint. This is the name, Evans Ongwae trading blueprint. EOTP. But you can eliminate this and just say ETP. So each time you want to enter trade, you must use ETB. So the first thing you have to identify is before you start even looking for strategy, because you must look for strategy that is going to work. You need a strategy that is going to work with the market, with the environment. So the first thing we have to learn is the environment. Or regime. The regime. There are many types of environment, but basically the only types we need to know, they are only two. We have a trend and a range. So a trend has high highs, high lows, or low lows, low highs. And please, if you have never learned about forex trading, this is going to be hard for you, but I know you are going to understand this. And this is going to have choppy candles. I know you understand it. I don't have to be right on the spellings. Choppy candles, and then the price rotates. I'm going to explain this. And what else? What else do you need to know about the trend? Okay, let's talk about volatility. Volatility is important. The volatility here is volatility. Volatility is low. And the liquidity is high. Liquidity is high. Hope you are there. So, when you are coming into a trend, the liquidity is very high, is very low, and volatility is high, and also the candles, the pullbacks are shallow, whereas the pullbacks are strong. Let's explain this before we move on. What do I mean by the trend? Trend, it is when the market is going either up or maybe it is going either down. So that is what I mean by trend. And range, it is when the market, and when I say range, it's when the market is going sideways. There is no up or down. It is going to sideways. That is the range. This is the range, and this is the trend, either uptrend or downtrend. So you have to understand about the environment. The first thing, you enter the market, look at the environment, or the regime. This is the high. This is like let's say the high, the high low. Understand that? Do you understand that? The higher high, the higher low. The higher high, the higher low. Higher high, higher low. You understand that? Lower low, lower high, lower low, lower low, lower high, lower low, lower high. Do you understand that? Okay, good. Let's talk about when I say it is choppy, it is because you don't know if when we are talking about if this is the range, then we don't know if this is the lower low, lower high. We really don't know. It is choppy. It is messy. And when I say the price rotates, it means that the price doesn't go anywhere. So it is like they are like circles. The price doesn't move upward or downward. It rotates because the price that is a value price, a fair value price. And the buyers and the buyers and the sellers have made an agreement that the price is fair. The price is fair. Do you understand that? This I'm giving you raw forex. So let's talk about liquidity. What is liquidity? Liquidity means the volume that is in the market, either buyers or sellers. Liquidity can be defined in a lot of ways depending on what kind of terms you love using, or maybe you are approaching trading from which kind of theory. But maybe some people use order blocks, some people use price actions, and it all depends on whom you ask. But what is liquidity? Liquidity is just buyers and sellers in the market, the total available buys or sells in the market, the available volume on the market. I hope you are understanding that. So, and what is liquidity? When liquidity is high, let's say the market was moving up. And then you see like the market is having trouble moving up. The market is having trouble moving up. The market it is having trouble moving up. That tells you that there's a higher liquidity there. Why? Because if the volatility is high, then the market should be moving easily because the liquidity is low. But if the market is not moving further, the candle is not moving further, then that tells you that there is a high liquidity and the volatility is going to be low. So the candles are going to be short. And this is where the volatility is very low and liquidity is very high. So the market goes to range. The next thing we have to learn is volatility. Volatility means how fast. This is how fast or the size of the price in the market. The price. When I'm talking about price, most if you're maybe new to forex, let me introduce you to what is called the currency pairs. Let's say we are going to take a euro, USD. It is going to be 1.1487. Now, what I'm talking about is this. This is the price, and you see, this is the base currency. This is the base currency. This is the base currency, and this is the quote currency. The quote currency. So, 1 euro is equals to 1.1487. You have to learn math in order to understand forex trading. That USD. So basically, it is like saying that euro divided over USD is equals to 1.1487. So basically, when this price of the euro rises and this rises, so you are selling this euro against while selling the US dollar. That is what it means basically. Do you understand? And this they are opposite because it depends on the strength of the currency. It depends on the strength of the currency. Please take notes. I'm just getting this out of my head. They are random because I already know all of this. These are just the basics. this is one we have to go into. This is number one. We have to go to or almost number 6, and as we move down, it is going to become more important and very clear to you. But if you are understanding till this point, I know that you are getting at least something. You are understanding something how the market really works. Everything I say, just quote it down, go and research more about it, because this is I'm going to teach you something that is never taught anywhere. You are not going to find this on YouTube. No one is going to teach you this. Everyone is going to bring you into the charts and try to tell you something from there, and you know that is technical, and we have technical analysis, and technical analysis is analyzing the candles. But I will tell you, the market is very random, and the market doesn't really repeat. Yeah, but it repeats. But what you have to understand is that greed, the reason why technical analysis works is because greed and fear never change. These are human behaviors, because humans are the one who trade on the forex market. Humans never change. People are the same people. That is why the technical analysis works. But remember, the candles, the techniques might not change, but the volume and the people and the participants, the volume and the participants of the market in the market, they are going to change. So you might find out that the pattern is the same, but the either the volatility is low, or maybe different, or the price is different. So that is basically it. And we have fundamental analysis. This is long term. This is when you are looking at the news, the Federal Reserve, the central bank, how they are behaving, and what is their tone. Basically, I'm hoping that you are understanding till there. I told you what volatility is. It is the how fast or the size of this, how fast or the size of the price. So if you see the trend, all the candles are moving high, they are long candles, know that the volatility is high, and you should probably reduce the size, the positioning size. When the volatility is high, you reduce the size, and that tells you that liquidity is low. So in order for the market to move from here to here, it needs liquidity. What is liquidity? These are buyers, or let's say the market is moving up. These are the buyers, or no, the sellers. Sorry, the sellers. These are the sellers. And they have made a limit order in the market, and the people who are buying, they are the aggressive buyers who are buying at the market order. You are going to understand this well when you look into the market. Let me write it down here. When the order book, the order theory. Go and look at the order theory, then you're going to learn about what I'm talking about there. So we are going to the pullbacks. The pullbacks means this. You see, as the market is going up, then it comes back. And if you already know what environment you are in, maybe it is a trend, and you know it is an uptrend, then you already know that people are not selling. This is just a pullback. So you are going to see mostly by the gurus who teach you. They are going to say, okay, the market is going to sell. No, the market is not selling. If the trend is upward, the market is not selling. No, that is a pullback. It is called a pullback. So the pullback, when we are trending, like let's say this, when we are trending, You see, the market is moving up, and the pullback is shallow. The pullback is shallow. It is not longer than this, and this is an uptrend. And new way. And once the market is going up and then down, now this pullback is strong, and that tells you that the environment, this regime, it is shifting. It is either shifting from an uptrend to a downtrend, or maybe from an uptrend to the range. I'm hoping we are together. So that is what is called a pullback. I'm hoping that you have understood what is an environment or a regime, and that is the first step we are going to, and that's the first step and the things we need to learn in order to really understand what is forex trading. I'm hoping you're catching up. That is a lot of information if you're a beginner, but I'm hoping it is very simple if you're someone who has been in the market and you really wanted someone to tell you how the market really works. So let me wrap this off, and so we can start on a new slate, and I will teach you and I will tell you more about the market. I hope that you are understanding and you are enjoying the video. This is very nice. This is very nice. This is very nice. This is what the traders are not going to tell you. These are what they are hiding from you, or if they are not hiding, they don't know what it is. And basically, I'm telling you, go all over YouTube and tell me you're going to find another video like this. Probably you should subscribe down below, because this is one thing that is going to change your entire life. And the problem you are going to encounter is you are not going to find capital. I know capital is going to be a problem. Also, capital is a problem to me. And I'm not telling you that this is 100% working. No, this is not a strategy. And the strategy is what is going to give you wins. But before you get the strategy and apply the strategy, there are some things you must understand about what is trading. What is the market? What is forex trading? Why is the market behaving the way it is? Why are the candles moving? Why does it feel so? What are the time frames? Then how does they apply? What is the importance? Why are they there? And that is what you are not taught. You are being taught, go on a higher time frame, mark the high highs, the high lows. But why? Why is that? Why is that? I hate these people who put everything that way. No, I'm cleaning the board. So I hate the people who present it that way, because these are the people who behave like teachers. Like a math teacher can come to class and start teaching about a certain concept or maybe a certain discipline, but not explaining really why they are teaching it. They themselves don't understand why they are teaching it. They don't understand why it is working. So most of these traders who are teaching these things, they don't really understand why they are working. And so basically, they are gambling. They are gambling with the self-belief that it is working. Yeah, trading, sometimes you lose a lot, you lose money. But it's not about losing money. Do you understand that? It is about the samples you have in the market. The samples. You must calculate. I'm telling you, trading is math. It is not about analyzing the candles. Nah. It is about looking at the price and seeing how people are behaving in the market in real time. So, I hope you understood that. I'm going to show you how everything really works out together. So basically, the second thing I'm going to teach you is I taught you about environment. The second thing I'm going to teach you is I don't think this is much more important for you right now. I told you that you also have to learn about macro liquidity. What is macro liquidity? This is when the central banks are tightening or easing the currency. When the reserve is rising the rates, the liquidity will contract. Expect sharp moves when the liquidity contracts. Well, I told you when when the liquidity contracts, the liquidity becomes thin and the volatility expands. Thus, the candles are going to spike off. They are going to move further. So there are sharp moves in the market, and this is we are going to find a high volatility in the market and more failed breakouts. If it is easing, if they are easing, if the and if the Federal Reserve is raising the rate or it is tightening, that is what you should expect. But if it is easing, it is known as quantitative easing. It is when the central bank or the Federal Reserve prints a lot of money in the market to counter inflation, or maybe to counter for a certain crisis that has happened. And let me explain this further in a bigger picture in order for you to understand. Remember when crisis happened, like in 2007, 2008, the housing crisis which happened in the US. I think it affected most of the currency because the dollar is imewekwa kwa a lot of currency. It is backing a lot of currency, so it affects a lot of currencies. So what has happened is that the Federal Reserve starts quantitative easing. What is quantitative easing? Quantitative easing is printing a lot of money to try to stabilize the economy. They must try and stabilize the economy but it is ending because they have been doing this for the past I don't know, almost 20 years now. So but we are going to reach I've forgotten the number. I'm going to tell you later on if I get a chance to remember. So don't trade against this. The easing. It's just this micro liquidity context. It is going to give you a background for expectations. You already know what is happening, so you have to understand the market before you go into the market and look for a good strategy that you are going to trade with. So basically, the second thing we are going to talk about is location. So let's head into the board again. We are going to talk about location. Location. The second thing is location. Location. What is location? What is a location? You have to go to the 4-hour candle or the daily candle. The daily candle. I want you to mark the previous week's high and the previous week's low. And I want you to mark a swing high. Swing means daily high, and daily low. That is what I want you to mark. Nothing else. I want only this. Only this. Why? These are going to behave. I don't know. Am I moving too fast? I don't have someone to hold the camera for me, or maybe I'm going to look for something which is going to hold the camera as I teach. So we have this is going to be our liquidity pools. These are going to be our liquidity pools. So what you should be asking is the price at extreme. What I do mean by extreme is okay, let me finish up. Or is the price at the middle. Is the price at the middle? That is what you are going to ask. I'm telling you, this framework is not going to go anywhere. This is just a framework of understanding the market before you look for a good strategy, before you do any strategy. This is what most people don't tell you. This is what you are not being taught. Please subscribe down below, because this is important information I'm giving you. I could be ending up this video right now. So basically, when the price is high, what I mean by the price is at the extreme. Let's say these are candles. They are moving, and this is the high and this is the low. So this is the weekly. Let me draw it much better. So what I mean here is that, look at these candles. You might be saying, oh, fuck you, shut up. Hypothetically, let's say this is black, selling, buying, selling. It's basically a pullback, but I'm going to say sell. So we are going to mark this area. Let's say this one. I'm going to use the charts later on. This area and this one. Let's say this is the daily range, and this is going to give you liquidity. So once the candle reaches this point, this is the extreme. This is what I mean. When they are in the middle here, don't trade. Wait until they get here. Wait until they get into the extremes. If this is the daily, mark it. See how the behavior happens. If they get to this area, these are the extremes. This is what I mean. So ask yourself, is the price at the extreme or is the price in the middle? If the price is in the middle, don't trade. If the price is at the extremes, now be ready to set a trigger. So before we move forward, that is the only thing you have to know about location. And location is very important because it is going to tell you whether you are ready to go into that trade. You have already understood whether the market, whether the environment and the regime. So the next thing you have to understand, where are we? The location tells you where we are at the moment. Where is the market at? Is the market at? Where is the market at? That is what location tells you. The third thing, I think I have to go faster because the video is going to be long than expected, because there are a lot of things to teach. But this is going to give you value. It is worth it. The behavior. You have to understand the behavior. What is the price doing at that location? What is the price doing at that location? What is the price doing at that location? Now, I told you, if we are not going to trade, to trade if we are in the middle. This is the extreme. Let's say extreme. This is the extreme. The extreme, and this is the middle. Don't you ever trade here. Don't you ever trade in the middle. I don't know if the market. Don't you ever trade in the middle. This is risking your money. Trade at the extremes. I'm telling you, trade at the extremes. And when you're at the extreme, ask yourself this: what is the behavior at that location? What is the behavior of the price? Now, I want you to drop to 1 hour. 1 hour or maybe 15 minutes. 1 hour if you are going to execute in 15 minutes, or maybe drop to 15 minutes if you are going to execute in 5 minutes time frame. You have to understand about the time frames. Time frames are very important in execution. The reason why we use 15 minutes or 5 minutes during execution, it is because 15 minutes gives us a good location. It is a 15 minutes. A 15 minutes it shows short term moves, which will clearly help us to spot entries and trends during the day. It is not too fast nor too slow, just at the right it is right for day trading. And because we are day traders, 1 hour also gives us a broader view of the trend. It helps us to trade and understand the market direction and avoid making tricky mistakes in the market, which will cost us a lot of money. So basically, you are going to execute either you're going to analyze using 1 hour or 15 minutes time frame. You are going to execute in 15 minutes or 5 minutes minute time frame. So there's nothing you are going to do here. What I want you to do is wait and watch the price and do nothing until the price interacts with that level, that extreme. When the price interacts with that extreme, this extreme I'm telling you, then ask yourself, what is the behavior? Does it break strongly or hold? Does it break strongly or hold? Is it a break or an instant reject? Or is a rejection? Does it stall? With tiny candles? So let me take this space and explain something. What I'm saying is that, is it strong? Does it hold? Does it break or does it reject? Does it stall with tiny candles? That is the question you should be asking. I'm not teaching you anything. I'm just giving you what you should be learning before you go into the market and start learning a certain strategy. So I'm just going. If you want to learn, you can comment down below. Learn. You can say, okay, now we want to learn this thing. So basically, the behavior is the order flow. I told you about order theory is the order flow. Order flow expressed through the price. You are watching liquidity in action. This is watching the behavior you are going to see here at the extremes. What does it behave? Does it break outside and continue on? Or does it break and go back into the range? This you are watching, that is liquidity in action. Oh my god, that is it. So basically you are watching liquidity at action. We have gone through the basics and the fundamentals, and we are moving now to the real game. Those were the basics and fundamentals you should have learned. And if you're calling yourself a trader or you want to go into trading, you must already know that. That is simple. Because if you are talking about a strategy, you already know what is an environment, what is a location, what is the behavior of the candles. You already know about the volatilities, the liquidity, and not only liquidity sweeps. Learn how liquidity is created. Learn about the market makers. Learn about the market, the takers, the market takers, the liquidity makers and the liquidity takers. You have to learn that. You have to learn about the micro liquidity context. Alafu you have to learn about the order flow, the order book, theories. You have to learn about the market microstructure theory. Those are things I'm not going to tell you. I'm not going to write down. Those who are interested, they can go back and look at them, look at it down. But if because this is something very crucial, and this is something is going, if you expect to, what do you expect to come with? Look, you are not going to work at a mjengo. You are not going to work as a teacher for the whole day, and you are going to make a lot of money. But what is the sacrifice you have to give in order to get this kind of lifestyle? In order to get this kind of lifestyle you want? Because when you are a teacher, you are not sacrificing to think. You are not sacrificing a lot of stress. You are not sacrificing your sleep. You are not sacrificing a lot of things. You are suffering, but at a lower state. And the person who is here is suffering, but at a higher state. And are you willing to give that away? Are you willing to learn the real trading and stop this security? I made 100k overnight security. My strategy in a work 99%. No, it doesn't fucking work. The strategy doesn't work. The strategy only works if you understand the environment, the location, the behavior, the triggers, and how to execute your entry, and how to position and risk management. That is the only thing that is going to get you there. And you have to understand how variance works. What is standard deviation? You have to think in probabilities, because we are not certain. That is why there is a stop loss. The stop loss is small. If you don't have a stop loss in your trading setup, you are trading randomly. You are a random trader. You are gambling. You are not even gambling. You are just another person there. Sometimes it works. You get your money and you think, now I'm a champion. But you have won in short term. Because maybe today you are lucky, you got lucky, you won. You got lucky, you won. But how about long term? Are you going to survive long term there in the market without understanding the psychology of the market, without understanding how things really work in the market, how everything is priced, why the price moves from this position to another position? If you don't understand balances and imbalances of the market. So basically, the next thing we are going to look at the trigger. I don't have to show you what the trigger is. The trigger, or maybe the what can I say? What can I say? What can I say? The trigger. The trigger is something which is going to tell you, now, if this happens, then we are going to do this. If the breakout is strong, then after and it goes into a pullback, which is shallow. After the pullback, we are going to execute. So if this happens and the pullback happens, we are going to do this. So if this, then that. If this, then what? If this, then that. What has happened? Then if this and that. That is the trigger. That is something which you should be instinct. That is not something which you are going to write down. No, it should be instinctual. It is something which you execute without even thinking. You know that, okay, fuck. Because the market is moving in real time and it doesn't wait for you. It doesn't give you 5 minutes to work. You have to execute on the spot. Do something and then the consequences come later. But that is why you have to master the positioning. You have to master risk management, so that you can enter the market without having second doubt, without even tensing, without having emotions. Because you already know, if it is going to fail, I'm going to lose this amount of money. That is why I was talking about we trading samples. You know that this sample, if I trade all this money and we go to a loss, we have like let's say 10 samples. And if these 10 samples go to a loss, then we have lost this $100. And if that is when we have blown all the accounts. When I was talking about variance and standard deviation, variance is how the spread, how the winning is spread from the average. If your average is something, then how far is it from your winning? Okay, same idea. Najua When you say that I see it wakati umelose, the next trade utaenda kushinda. No, it is independent. That is probabilistic thinking. It doesn't necessarily mean umewini ukalose, una win utalose, ukilose utawin, utalose alafu utawin. Utaweza lose if you lose hata mara 50. But that is why you have to trade in samples. You already know that nikienda mara 5, okay, si inamaanisha mara 5 nyingine itaingia na ndani. Hapana, inaenda tu mara moja. That is thinking like a trader, a real trader. Have a poker face. Trading is a real business. Theater ile mtu unaona na online wanasema, "Yeah, no, that is not trading, bro. Trading is a business." So, that is what is called a trigger. You have to develop, if something happens, then what happens? Then the risk management. The risk is what keeps, I don't think I'm going to write this down. So, but the risk is what is going to keep you alive in the market. Before you buy or sell, calculate the positioning size. How do you calculate the position size? That is simple. Go online and look for it. I already have the formula here, but if I don't let you go and look for it, you are not going to do research, and you are going to come back to this video and say that, Everson, why you taught me about Forex trading? You taught me the basics, and now I went into the market, I lost money because of you. No, I'm not going to give you that. Go and do your own research. I'm here to educate you. I'm not being paid by the brokers like the other YouTube gurus. I'm not even a YouTube guru. Understand that? Look at me. How do I look? Do I look like a guru? Do I look like I'm trying to sell you something? I'm giving you raw information which is going to help you somewhere. The stop distance, calculate that, and the position size. That is what I'm telling you. Don't change the stop to reduce the size. Only change the size to respect the stop. If the stop is random, your trade is very random. Trust me. The sixth thing is management. This is where most traders, they destroy their edge. Once in that trade, once you have calculated the risk, the 1% risk, or maybe your percentage, the one you will be able to tolerate and manage, you calculate your positioning size, and all the trades are going to have the same position and the risk. So you know how many, with your account, the total amount you have, you already know that you are going to make how many trades. And if it's going to be profitable, you don't go into the market again. You already know that you are going to make 10 trades in a day. And then those are the trades you are going to have. You must have discipline in trading. Trading, you must have discipline. So, you do nothing unless you do nothing when you are in the trade. When you have pressed the button execute, buy or sell, you do nothing. Maybe the structure breaks against you. The structure breaks against you. Now you are trapped. You need to escape. You either do what is necessary for your account. The most important thing in trading is capital preservation. So if you see the market is against you and you made a mistake somewhere, exit the market. Never trade against the market. The second thing is the target is reached. Once the target is reached, go out of the market. Now you can interfere with the market. You can interfere with the trade. The third thing is volatility spikes. When the volatility changes, know that the regime is changing. So the strategy that you enter the market with is going to change, because I told you volatility is interconnected with the liquidity, and it is interconnected with the regime. So if volatility is spiking and usually it is changing, note that the strategy that you are using, the strategy that you are being taught, but that you are being sold online, or maybe you are being taught, that strategy will not work if you don't understand what I'm telling you. If the volatility is changing and it's spiking, change the strategy to maybe from, if you are trading and the strategy was a range strategy, change it to a trend strategy. If it was a trend strategy, change it to a range strategy. No micromanaging. Don't interfere with the trade. No emotional adjustments. That is why you have to understand that you are trading in samples, and you are willing to lose all your money, and you are willing to gain all your money, because this is a very risky profession. Trading is a very risky profession, and you should know that most traders, retail traders, they lose their money because they are being taught by YouTubers, they are being taught by the books they read, they are being taught by the people who don't have intimate connection or understanding how the market makers, they don't understand the market makers matrix. They are in the matrix of the market makers. They don't understand the matrix. The professional mindset you should have is that outcomes don't matter. Whether you lose or you win, it doesn't fucking matter. What matters is the execution. Already you executed your edge. Whether it goes up, it goes down, it is none of your fault. You know that you did everything as Evans Ongwae taught you. You did everything as the the trading blueprint. The Evans trading blueprint. ETB, you did as E-fucking-T-B told you. The ETB framework. You use that framework. You know that it is not your fault. There's some things we can control, and there are other things that are out of our control. The market is out of our control. We don't move the market. We don't make the market. We only follow along. And if it goes against us, change, go out of the market. Protect capital preservation. And if you made a mistake, capital preservation matters. Trading is a very risky operation, and your execution matters. That is what you have to understand. And we try to predict the market and trying to preserve our capital. So it is a very risky thing. So I will walk you through everything from the beginning to the end. I'm hoping that you learn something, but this is what you have to learn so that you are going to be profitable in the market. The first thing, learn about environment. These are the notes that I've been using because I needed to guide you in a proper way. The first thing, you learn about the environment. Environment, I told you, there is our only trend and range. Then we need to learn the second thing, the step 2, look at the location. Is it in the extreme? Is it in the middle? The third thing you have to learn is the behavior. Is it a breakout or a rejection back into the range? The third thing is setting a trigger. If this happens, then what happens? The fifth thing is the entry. Execute the trade without emotions. Execute the trade. Don't be emotional. Your execution of your edge matters than the outcome. During the trade, watch the volatility spikes, because if the environment is changing, you have to change the strategy and the position size. So that is what you have to watch, but don't interfere with the trade. After the trade, I want you to journal down what worked and plan on the trading samples. The trading samples I told you is how are you going to trade in samples without getting emotional, and refine your strategy. This framework you are going to use, it is okay. Now let me tell you where the strategy comes in. The strategy comes in during the entry. Once you understand if this happens, then something happens. Then understand that if this happens, then this. Now that is the strategy. That is where the strategy comes in. But first of all, understand the environment, the location, the behavior, the trigger, the entry, the during, and the after. And this cycle is going to give you 80% win rate. This is going to give you 80% win rate. But it doesn't necessarily mean that if you have 80% win rate, you are going to be profitable. Let me warn you. It is not about being profitable. Profitable is the win rate multiplied by the profit minus the lose rate multiplied by the number. The win rate multiplied by the profit size, the profit price, cash you make from there. You already understand. I don't know how to use the terms. Multiplied by the the loss rate. So multiply by the loss size. This is what is going to give you to make you profitable. You are going to understand if you are positive, profitable, or negative. You are going to understand if you are positive or negative. But this framework I gave you, it is going to give you 80%. So how you micromanage your trade, your winning rate, your position size, your risk management, it is going to be the one which determines how you are going to be profitable in the market. So basically, I will finish by saying this. I'm Evans. Why? "22 years millionaire from Kenya," and subscribe to my channel. Comment what you didn't understand. Comment what you want to learn. Comment what you didn't understand and comment what you want to learn. My name is Evans. Ongwae. I'm a 22 years old millionaire. I'm a Forex trader. Subscribe to the channel. Comment what you want to learn. Comment down below what you want to learn, and we will get you to where you deserve. We'll get you to where you need to be. So basically, have a lovely time. Comment down below. Peace out.